Happy Friday. Today is Friday, June the 8th. And thank you for tuning in to Mark's 10 at 10, June the 9th. Sorry. Uh, so, short week this week in terms of or a light week in terms of news. But here's a couple things that I want to share with you. This is the first quarter since 2012 where there has been a decent decline in some markets in the equity that they have. So, according to CoreLogic, rather, owners with a mortgage saw a small decline in their equity last quarter, down 0.7% from a year earlier, making the first annual decline since 2012. The drop amounted to about $5,400 per borrower. But home equity changes varied widely across the regions. The western states posted the biggest losses, led by Washington, California, and Utah, which makes a lot of sense. In the San Francisco area, the typical homeowner experienced an equity loss of about $174,000 year over year. And you have to keep in mind for those Bay Area people, and my wife's from the Bay Area, and we know lots of people out there, but they have had the massive run up. So when you talk about, the average price per square foot being one of the highest in the country and even in the world, when you drop from 1.6 million down to 1.5 million on an average purchase price, then it's not as bad as it seems, right? So on the other side, though, owners in 6 states, including Florida, Connecticut, and New Jersey, increased their equity positions by $20,000 or more on average. And among the 46 states and the district and DC, District of Columbia, which data was available, only 15 of these states recorded a loss from a year ago. So next, I want to tell you a little bit about what's going on. So there's been, you guys know, there's been all this talk about the loan level price adjustments, the LLPAs, and how it's not fair for people that have good credit to be dinged up for their credits for their rate when they have good credit. And so the National Association of Mortgage Brokers this week were backed by a Republican-led bill in-house aiming to reinstate the loan level price adjustment structure that was in place before these changes, which is back pre-May 1st. So this seeks to roll back some of these changes based on the debt-to-income ratio. It also calls on the Government Accountability Office to scrutinize FHFA's revisions under the Enterprise Regulatory Capital Framework. And what the NAMB president said, the National Association of Mortgage Brokers president, Ernest Jones, said borrowers have demonstrated a propensity to manage credit in a responsible manner, should not be penalized when obtaining financing. So I think we can all probably applaud that, as it seems like there has been nothing mostly negative on those loan level price adjustments that have come out. Next, most potential home buyers, according to BMO Financial Group, the 8th largest bank in North America, they just released a survey saying that nearly 2/3 of Americans are waiting for rates to go down before they buy a home. Among those people who want to purchase a home this summer, or home soon rather, among the people who want to purchase a home soon, only 6% plan to do so this summer, which is supposed to really be the high season for real estate agents and for realtors and builders and so forth. Refinancing plans are put on hold, as you might imagine. 81% said they're waiting for rates to drop. That makes obviously a lot of sense there. But the fact that people are using this time to wait, when we've talked about this many, many times, you have to remember that when rates go down, which is what a lot of these people are waiting for, prices will go up. So why is that? Well, when rates go down, then more people enter the market, which causes more competition, which makes the sellers less amiable, less negotiable, less likely to reduce their price or provide a seller concession. So as counterintuitive as that sounds, that's the reality. So it's one of those things, guys, where this is truly one of the times where you want to make sure you have the right information. You don't want to be listening to the masses. The masses right now are going to wait until rates move into the mid fives. And guess what? As we've talked about, BlackRock, all of those institutions, JP Morgan Chase, they're going to re-enter the market as well, because now their metrics are now going to be where they want them to be able to get the returns that they want. So it's going to be this flood into the market with everybody and their neighbor fighting over the same homes again. So I know that's not necessarily what you want to hear, but you have to use the information that you know is likely to happen for your advantage. And what is that advantage? Well, if you're looking to buy a home, you can get a better deal on it than you could a year ago right now in many, many markets. All right. Not every market. I get it that some of you guys that I talk to that are in some really hot markets, whether it be in obviously Seattle, and a lot of these places are still seeing multiple offers, whether it be in California, New Jersey, Maryland. We got a lot of feedback, Miami, but those places where you're seeing a little bit of a pullback, the time, in my opinion, and the data shows that now would be a better time than a year ago, and now would be a better time than a year from now, because rates are starting to come down. Now, let's talk about when rates will come down. Initial jobless claims. So, guys, remember, what is going on is the Federal Reserve is trying to pump the brakes on an economy that has been steamrolling, going really, really well, and it's caused inflation. Well, by stomping the brakes, what do? They raise rates so that people will borrow less, and it causes companies to borrow less, which causes companies to actually give layoffs. They lay off people. So we all of us are, this is the reason why we put out these numbers about the jobless claims. Again, counterintuitive, but the jobless claims, we want to see a bad report, because a bad report would mean that the Fed, what they're doing is working, and that that inflation is coming down. Because remember, inflation is what really follows, rates follow inflation. Mortgage rates follow inflation. The mortgage bond market follows inflation. Mortgage bonds are not good investments when inflation is rampant. Mortgage bonds, we need to be a healthy market, because a healthy mortgage bond market, healthy mortgage-backed security market is what helps mortgage rates. It makes mortgage rates go down. So initial jobless claims report just came in. It was the worst in 20 months. And remember what's going on here. There's this huge lag. So we'll pick up this month and we'll drop last 12 months ago. Well, these things are on these numbers on such a big lag. At some point, guys, we're going to get a report that's really stinky, a really bad jobless report. And I don't know when that's going to be. Is it going to be July? Is it going to be August? But this will bring down inflation numbers, which will be good for bonds, which will be good for mortgage rates. So that's today's message. I know one more thing I want to say. A lot of people are facing big issue right now with trying to buy and sell at the same time, or trying to maybe buy without selling, and maybe keeping their current home with their current low interest rate. We are coming up with strategies where we're doing strategy calls with clients right now that are wanting to do this very thing. And we're teaching people how to keep their current home, rent out their current home with their rate that's in the 2s or the low 3s, collect enough rent to cover the payment on that, pull the equity out with a home equity line of credit to use for a down payment on the next home that they want to purchase. And now teach them how to pay that home down quickly with an alternative type of financing called the all-in-one loan. So I just showed a client how to purchase the new home, pay it off in 6 years. Once it's paid down, they'll be able to draw back off of the all-in-one loan, because the all-in-one loan moves two ways. You can put money in, pay the loan balance down, but you can also pull money back out. And when you pull the money back out, they raise the balance back up to pay off the previous home that they moved out of. And now they've got a balance again on their all-in-one loan, because they already paid it down once. Now they work to pay it down again. So this particular client, I was able to show how to pay off the debt on the previous home in 9 years, after I showed them how to pay off the new home in 6 years. So for a total of 15 years, we have a game plan now to where they'll be completely debt free and have a cash flow of about $8,000 per month, have two homes worth over $1.5 million a piece. So this works. This can work with any price point. So whether you're in, you don't have to be in $1 million price point. You could be in a $500,000 home or $300,000 home and be thinking, man, I really want to stay here. I really want to keep this low rate. You should. If you want to keep that house, look, guys, homes are like huge commodities now. You have everyone that's out there. You have hedge funds that are buying single family residence. If you're under $350,000 or perhaps even under $500,000 in some markets, that is the most competitive market right now. You're going to have more competition because you have institutional buyers, and it just makes it difficult. So you've got to have a plan. What is your plan over the next 5, 10, 15 years to have interest so you're not paying interest forever? So you can have your interest costs mitigated. With the all-in-one loan, you can mitigate sometimes 70% of your total interest cost. And it does this in two ways. The all-in-one loan does this because it's going to change it. It changes the way the interest is calculated on a mortgage. It's completely reinvented that. And number two, it changes the way that mortgage payments are applied to the mortgage interest instrument itself. So those two factors make it a speedier pay down time. It's just I'm on a mission. I'm on a crusade to teach people in this country who are so accustomed. 94% of people get a 30-year fixed mortgage. It just so happens that the 30-year fixed mortgage is the most expensive loan historically, mathematically, for homeowners. And by the way, the 30-year fixed mortgage is the most profitable for lenders. So what does that tell you? Maybe, having the most expensive mortgage out there is not the best thing for you. Maybe, you are open to other alternatives to paying down your mortgage debt faster while also maintaining liquidity. And that's what you're able to do with the all-in-one loan. So if you'd like information on that, just drop me a DM and we'll get you scheduled on the books and book a chat. We do this on a daily basis, my team and I, but the spots do fill up quickly. I have a Calendly link where you can go and log in and snatch up one of those spots. But we do spend 15 or 20 minutes with each client or prospect. And so we do get into the nitty gritty with you to show you exactly where you stand. And so if that sounds like something that would be helpful for you, grab one of the spots and I'll drop a link below for that. And then you can grab one of those spots and we can hop on a call and we can talk about what your future looks like. So you guys have a great weekend. Sorry, I went a little bit long today.